Since the introduction of computer models and algorithms, a new reality has entered the financial markets. Better and faster than human traders, machines can be so good, they make humans obsolete instantaneously. But since there is very little human interaction these days, this opens up the potential for massive failure. A failure nobody could react in time to stop. You came here for the truth, so let me unveil that for you. Today we're going to look at the flash crash. It's a topic that doesn't get talked about. Sure, there have been books written about it and there have been articles, but on a daily basis, there's no consideration made to this very important subject. Well, that's why you came to the Money GPS, because you need your dose of the truth. Looking at this, since the 2007-2008 financial crisis, computer-based trading has implicated in several sudden market moves. Here are four examples. You're looking at the S&P 500 here in 2010, the Dow Jones in 2015, in Brazil 2017, and the so-called Treasury tantrum in 2014. All of these markets different. Around the world, we are seeing the exact same thing. This occurs in just about every type of market, whether it's futures, bonds, stocks, anywhere and anything could be affected by a flash crash. Now, why? What was the result of all of these? What was the reason for all of these? And that is computer algorithms. They are the reason why, simply because they're doing all the trading. In fact, almost 100% of trading, when you total it up, is done by computers. And that is very frightening. Not just because the potential for job losses or anything like this. I'm talking about the fact that if these flash crashes have been shown to happen very regularly, there have been instances in the past where trading has to be halted, maybe just for a few hours, maybe just for a day. But what happens if a flash crash is created, whether intentional or not, doesn't matter, that halts trading. Now, you as the individual, you can't get your money. So is it safe? Well, that's up to you to decide. So you have your money in a stock, and that stock is now significantly lower than where it was. Let's say you bought it at $10, the stock crashes down to $1 and they halt trading. So that would be okay for you because you know that they are trying to stabilize that particular stock market or whatever it was, and they will then reopen only when the market feels it is stable. So you may feel confident. Well, that's fine. So what happens to your money in the meantime? Maybe it's 4 hours, maybe it's a week. Well, what happened to your money? Well, your money's invested in the stock. The stock is apparently still with that company, but, well, is it really? We need to look at that a little deeper because your money's locked up with them and you don't have a way of getting it out. There's no way. And then the stock market may reopen. At that moment, what will your stock be worth? You don't necessarily know if the algorithms will be right on that sell button as soon as the market opens, and it could drop even further. Sure, maybe it might go up, but what if it doesn't go up to where it was before? And that was a computer trading on false data, on some sort of wire that was tripped. Stock went down. Let's say it goes back up, and now instead of at $10, it's at $8, just because of the way everything happened. And that was all because of computers. Computer algorithms ruining everything. They are pervasive within this market, and there's no way to get around it. I just want to bring to light the potential failure. That's all I'm trying to bring out here. That's all. Looking at this. Rise of the machines. Hedge fund assets managed via quantitative strategies have nearly doubled since 2007. We are seeing these numbers rise dramatically over the years, and everything that has gone wrong during the housing crisis and into the financial crisis, nothing at all has been learned. Every single thing that was bad about that crisis has been expanded. We've seen debt expand. We've seen the amount of margin that people are using expand. We are looking at the interest rates being rock bottom. We have banks that have been gone just into ludicrous territory about what they're doing, their activities on a daily basis. We've seen derivatives become the norm now, and it doesn't seem to be getting any better. So when you add on that, these computer algorithms trading on all this bunch of garbage that's out there, it's a recipe for disaster. Something really big is going to happen, and it may have nothing to do with any piece of reality. Not some activity that's going on in one country or another, not because of loss of confidence or anything. Just a glitch. A glitch could ruin everything. This is very good. This is out of Barron's. The proliferation of computer-driven investing has created an illusion that risk can be measured and managed, but several anomalous episodes in recent years involving sudden, severe, and seemingly inexplicable price swings suggest that the next market sell-off could be exacerbated by the fact that the machines are at the controls. Exactly what I'm just talking about. This is what we have given them the rights, the access to do. Yeah, sure, trade. It's all you. It's all on you. Don't worry. We'll sit back, we'll have our coffee, and we'll relax while the machines do all the work. That's fine, except when things go wrong. Right? Looking at this is the new record short on the VIX. Once again, it keeps breaking its record over and over again. Other than a few blips along the way, this has been extremely low. And people keep shorting it, and so far, we haven't seen anything change. This seems to be the most calm market ever, despite the fact that everything is actually in turmoil. I don't know what's going to happen here, but this is going to make some people very, very rich. And a lot of people very upset in the meantime. Netflix, looking at this here, a company that is one of the FANG stocks. They have performed very, very well over the years. We have seen not just Netflix, but the rest of them do very, very well. And despite the fact that their PE ratios, that some of their financials don't really add up, the amount of actual earnings that they have compared to their stock prices, it doesn't matter. Because the market is in a state of euphoria, and we are looking at this right now to be the be-all and end-all. You need to invest in the FANG stocks, and you do very well. The reason that they are doing well is because the central banks have been buying up shares. Then you have the little guys just tagging along. And this doesn't really show the strength of the market at all. In fact, it shows the weakness, but it just keeps going. So there's no telling how far this can really go. Cash content spend in billions by platform. What we are doing here is comparing Hulu, HBO, Amazon, and Netflix. And by far, cash content spend, you're looking at Netflix burning through a lot of money by far versus their competitors. Now, what we can see here is that they are doing this. Sure, they have been getting new subscribers all the time. Their business is expanding, but the amount of money that they make compared to the amount of money they spend doesn't really justify the stock price. That's why the PE ratios have gone way out of whack. That's why we have seen such lack of understanding by those in the know with all of these stocks. They have no idea what to expect. Everything's out of whack. Nothing makes sense, but here we are. And then last but not least, just want to talk about this very quickly. For the first time ever, more New Yorkers are using ride service vehicles like Uber than the city's famed yellow cabs. The Uber actually surpassed the amount of cabs, taxi trips by quite a bit here. 289,000 Uber rides versus 177,000. Taxi trips. It's something that's very interesting, and a company that didn't exist just a few years ago is already surpassing what has been around for a very long period of time. And in a place like New York, of all places, that's something that's very interesting to me. I thought I would bring that to you. We can see that technology could make some people very, very rich. It could do wonders in some ways. And at the same time, it pushes things out the door. So we need to be very careful in where we put our investments, where we put our energy, and understand that times change. So if you found this video informative, please give me a thumbs up. Remember that when you give me a thumbs up, it helps to support this channel. It also tells me and tells other people that this is good content, so that I'll know that this was the good ones, and I do appreciate that very much. So you're telling other people on YouTube, hey, look at this one. And it does that by pushing the videos higher up in the search rankings. It's more likely to be recommended, more likely to come up on the little sidebar there. So when you give me a thumbs up, I do appreciate that. In fact, and I'll give you a little tidbit of information, if you give me a thumbs down, you are actually helping me just as much, because it is engagement, whether that's a thumbs up or thumbs down. When you give me negative comments on here, thank you very much, because you're actually supporting the channel, believe it or not. That's the way YouTube works. Not my rules, but that's the way it is. So thanks to everyone, I would say. If you found the video informative, I know you'll find my books, The Money GPS and my newer release, Global Economic Collapse, even more informative. You can actually flip through these books. If you go over to Amazon, they have a look inside feature that will allow you to flip through the pages of these books to see if you like them. Take care.